Welcome to episode 4 of the Fund and Gain series, The Road to Your Financial Future. This episode is titled Basic Fundamentals. Now, Basic Fundamentals provides a fond reminder to me of my basic training days in the Army when basic fundamentals were drilled into me. So look at this as your basic training in managing your retirement investing. Now, to exercise the John Bogle virtue of independence of thought, investors need to be able to assess their investment alternatives, to make wise choices, and to continuously monitor their portfolio performance. This requires some simple numerical capabilities. I spoke in previous episodes about rewards or returns from your saving and investing. I also introduced volatility as measured by the standard deviation, which is used as the most common measure of risk. I even displayed the formula for standard deviation very briefly on the screen. Now, these are two of the basic metrics that you as an investor will need to understand, and more than that, to utilize on your own. So in this episode, I want to review these, that is the rewards, returns, and volatility, or the standard deviation, and apply them in some examples. Now, a lot of data are available from Yahoo Finance, from mutual fund websites, and from many other sources on the web. And this information will help you as you conduct your own independent assessments, and you make comparisons using these simple tools. Now, actually, I have to say this episode turned out to be more time-consuming to prepare than I anticipated. I ended up with a lot of charts and graphs, which I will display on the screen. Tables and charts. So the presentation of these will be kind of an experiment, which I hope pays off and proves effective. Let's start with returns. Returns are the gains or losses measured over a certain period of time, say a year or 3 years or 100 years, and are generally expressed as percentages. It's also important to distinguish between price return and total return. And the best way to explain, I think, is to go through an example. And I will use Verizon stock in this case. Now, the price return just takes the starting price as the base price and computes the percentage change based on the end of period price, in our case a year here. So assuming that you own this stock for the entire year, we just compare the December 31, 2009 price of $30.97 with the December 31, 2010 price of $35.78, which computes a 15.53% gain. Now, first we compute the actual gain in price. This is one way of doing it. $35.78 minus $30.97, and then divided by the beginning share value of $37.97. This gives us 1.1553, and that converts to 15.53%. Now, obviously, if you bought the stock after December 31st, 2009, or sold it before December 31, 2010, you would have to compute the gain using a different starting or ending price. The key thing is this computation does not take into account the dividend payments that you received or would have received during the year. So the total return assumes that the investor reinvests all the dividends or interest payments back into the asset or portfolio, and so includes the reinvested amounts along with the price change in the calculation. Now, the table you see shows the dividends, the payment date, and the closing price on the payment date for Verizon in 2010. And it computes the fractional share amount that would be bought or would have been bought with each dividend, and adds this to a cumulative total of fractional shares. And so the end of the year share total times the final price yields an end of the year total value that is used to compute the total return, basically the same way as we computed the price return. Now, excuse me. As you can see, the total return is 22.3%, and this is considerably more than the 15.53% price return. So the dividends can be a very important part of the return. And for bonds, interest payments are basically the equivalent of dividends, let's say, and comprise the major part of your bond return. So total return is the one to use to evaluate the performance of your retirement portfolio. Now, mutual funds report this on a regular basis. And you can see samples on the screen from the Vanguard website for two funds VFINX, which is the S&P 500 stock fund, and VBIIX, which is an intermediate bond fund. Now, each example shows the return for the fund and for its benchmark index. And as a quick aside, you can see for each fund that it tracks its index closely. Now, the investor, which is what this means, is the investor is capturing most of the returns that the market is providing. So let me go on now to average returns. And generally, you'll be interested in returns for more than a single year. And the Vanguard examples I just showed are fairly typical and of mutual fund reports. And they report returns for differing time periods, such as a quarter, 1 year, 3 years, 5 years, 10 years, or since the fund was started, which they call the inception date. So returns for a period longer than a year are presented generally on an annualized basis. And what the mutual fund report is showing is really the average return over the given period of time. So right here we need to distinguish between two types of average return. The arithmetic average, which is also called the mean return, and the geometric mean return. Now, most of us are used to dealing with the arithmetic average. It simply sums up the entire set of numbers, in this case returns, and divides the total by the number of returns, in this case the number of years. So the table you see right now shows the annual total return data for 14 years from 1997 through 2010 for the Standard & Poor's 500 stock index. Now this return data is in decimal format. And you can see 3 fat years from 1997 to 1999, followed by 3 lean years. This is followed by a nice recovery, and then the gut-wrenching loss of 37% in 2008. So using this return data for the S&P 500 from 97 to 2010, we can compute the average or the mean return of 7.9% for that 14-year period. But this significantly overstates the actual return received by investors. The charts can help visualize the numbers, I think. So what you see in this bar graph of the data is the same in this previous chart, but you can more clearly picture the ups and downs of the S&P 500 index during these years. Now, this graph was created using Excel, by the way. The geometric mean has to be used to calculate the investment returns. And this is true since each year's starting asset value, kind of like we did in the Verizon example, in this case the starting asset values multiply the return for each year, and then the value of the portfolio or the fund over multiple years is generated by a series of multiplications. And in our case, for the example, you can see the geometric return is 5.7%. That's quite a bit less than the arithmetic average of 7.9%. Now, as a practical matter, the geometric return will always be less than the arithmetic average. And you just need to be aware that you cannot just use simple arithmetic average in evaluating funds and returns. So I'm going to show the return here, the formula for the geometric mean. The only thing that might be difficult is extracting the nth root. In the old days, you had to use logarithms. Fortunately, this is simple to compute using Excel today. And by the way, I believe that Excel is a fantastic tool, and I recommend that everyone learn to use Excel. Now, the geometric return is not defined if any of the values are negative, and if one value is 0, then the whole thing becomes 0. So we know some returns are actually negative, and we need some kind of a way to get around this. Basically, we use the formula 1 plus the year, or 1 plus the return for each year. Now, by multiplying the returns over the years together, the 1 plus each return, you have an index value for the period of n years. And now you need to compute the nth root of this index that is at the end of the period. So you simply use the power function in Excel and subtract 1 from the result, and you get the decimal value of the geometric mean. And I show an example of this computation for the period of 1997 to 2001. And in this case, we use the power function to evaluate 1.66223 with a power of 1 over n, which is the number of returns. In this case, it is 5. So then you subtract 1 from the overall result, and you get a decimal value of the geometric mean of 0.10699, or rounding, it becomes 10.7%. The geometric return is what you earn as an investor. And thus, if you had, let's say, $25,000 of your portfolio invested in an S&P 500 index fund, such as VFINX, at the end of 1996, it gained 33% less expenses in 1997. The end of the year value for 97 would be $25,000 times 1 plus 0.334, which is $33,350. In 1998, the gain would be $33,350 times 1.286, and that would bring you to $42,888. And computing this in this manner for the remaining years yields a portfolio value of 2.17 times $25,000, or $54,253 at the end of 2010. Now, most funds show performance charts that cover a period of years and illustrate how a hypothetical lump sum investment would grow or not over several years. And I think the index approach is a little more useful. It's a very similar thing. It just uses 1 instead of some fixed amount of money. And really, by doing your own analysis and your own computations, you can more easily compare performance over a period of time that is appropriate for you. Now, for example, what you see here is based on annual total return data for the period of 1997 to 2010 for the S&P 500 index, which we've seen before, and the Barclays Capital Aggregate Bond Index. This used to be the Lehman Brothers Bond Index while Lehman Brothers was still around. Now, you could do this for 2 mutual funds like VFINX and VBIIX as well. Now, what I like to do here is to create the index, and as I showed before, using 1 as the base value, in this case for 1996, for each asset, such as a fund or the asset class as a whole is represented by the benchmark, which we're doing here. Now, by plotting the computed index values for each year, you can visualize the overall performance along with the volatility of various assets or asset classes. And you can then use this index to compute the geometric mean for each item or class or fund that you're looking at. Now, what is very interesting here, by the way, is the performance of these 2 indices. And I quoted Burton Malkiel back in episode 2, where he said that stocks historically offered a higher reward accompanied by higher risk than bonds. And also noted that higher risk does not guarantee higher reward. And that is clearly illustrated here. And just by plotting the performance data, you can clearly see that the bond index actually outperformed the stock index over the 14 years from 1997 through 2010 with much less volatility. Now, what this will look like a few years from now is anybody's guess. But this type of information is what you need to look at when building your asset allocation and saving for your retirement. Now, let me talk a little about standard deviation again. As you can see, there is a wide variation from year to year in the S&P return data. And this variation, as we have noted, can be quantified as the standard deviation. As you heard in a previous episode, O Fortuna, this is called volatility in the investing world, and it is used as a proxy for risk. It really provides a measure of how far the various observations, that is each individual return, how far these observations are from the average return. So the larger the standard deviation, the more spread out the values are. And you can see that from looking at the chart. And what I'm showing here now is the formula for the variance, and which is S squared in this case, and S is simply the square root of the variance. Using the standard deviation has the advantage of bringing the variance into units that are equivalent, in this case percent or decimal point returns, and the standard deviation is in the same units. So The standard deviation is the square root of the variance, and it's really the average, and the variance is the average of the sum of the squared deviations from the arithmetic mean. This sort of sounds complicated, but it really is not. And you square the deviations, and thereby you can get rid of all the negative values. Now, taking the root, again, as I said, is what allows us to work with the original units, which is the percentages in decimal form. Now you can see here the x sub I are this is the notation for the individual returns, and the x sub mu is the mean, or is the arithmetic average return. And the big E looking thingy is the symbol epsilon, which means that we sum all the squared deviations. And n is simply the number of returns, which in our case are annual returns. Now this formula is slightly different from the one I displayed in episode 2. And this is the formula for a sample of a population, and rather than the entire population. So it uses n minus 1 rather than n as a divisor. And I don't think we need to go into this as a big deal. This is what Excel uses in its calculations of standard deviations. Now I'm going to show a sample calculation. It's a simple process really, but it can be tedious if you have a lot of numbers. So let's just go through a sample calculation and just to illustrate what is involved. And Excel again allows you to calculate the standard deviation directly and very easily. And by the way, have I said that Excel is a fantastic tool for investors? So I'm just going to use the first five of the S&P values. That's the first 5 years beginning with 1997. And you can see the mean and the standard deviation as computed by Excel directly in column 2. Now I would say to learn more about standard deviation, just go to Wikipedia. Very often, I'm going to say just 2 minutes or maybe less actually, about the bell curve. Very often the Greek letter sigma is used to designate the standard deviation instead of S, which relates it to the bell curve. And I have to at least mention that the bell curve at this point, also known as the normal curve or the Gaussian curve. It is crucial to much of modern investment theory, and the key thing is that the bell curve is completely defined by the mean, in this case the arithmetic mean, and the standard deviation, and it allows you to make many assumptions, rightly or wrongly, about the performance of your investment returns, particularly in taking a look at possible future returns. So I'm going to have more to say about that in later episodes, but I just wanted to bring it up for the moment. Now, let me take a couple of minutes to illustrate to you why past performance does not guarantee future results. If you recall, I mentioned that we really are using all these calculations to look at past performance and to try to assess future performance. But you see this warning on just about every financial document that you read. Past performance does not guarantee future results. And I did talk before in one of the previous episodes, and I said that at one time I simply looked at the mutual fund 3-year or 5-year performance, and I tried to pick the best based on 1 or 2 funds based on that performance. So let me show you why that is basically useless, or mostly useless. And what you see now is the same S&P base data from 1997 to 2010. But here what I'm showing is the 3-year rolling performance and standard deviation beginning with 1999, since I had to allow for the first 3 years to make this first calculation. And you can see the radical changes, and that picking a fund based on three-year histories is a problem. Now, in several cases, the return dropped significantly. In other cases, the return was far higher than the predicted, let's say, by the previous 3 years. So you have to find a better way than 3-year performance to select the assets for your portfolio. And this is where asset allocation comes in, and I'm going to cover this in future episodes. Let me put in just another reminder at this point. The range of returns and the recovery from a loss it can sometimes fool you a little bit. Percentage gains and losses are asymmetrical. You can only lose 100%, and that's all your money. Gains are unlimited, which is a good thing. And as an example, the S&P returns range from as I say, an exciting 33.4% gain in 1997 to a very dismal loss of 37% in 2008. And as you can see, there was a significant recovery from this loss in 2009 and 2010 of 26.5% and 15.1% respectively. But don't make the mistake of thinking that since that 2-year 09 and 2010 total gains adds up to 41.6%, which exceeds the 37% loss, don't make the mistake of thinking that we're ahead of the game. You're only back to a little over 91% of your original value. And you would need a total gain of 58.73% just to regain your starting position. Clearly illustrated by the example, if you have a 50% loss, you need a 100% gain to get back where you were. That is why large losses are so dangerous. And if you are down the road and you have accumulated a relatively large portfolio, the dollar loss can be huge. And furthermore, you will find it difficult to recover from a single catastrophic loss because you really have less time to do so. So, caution is really the word of the day. Now, let me talk a little bit about the combined saving rate and rate of return over time. In the last episode, Don't Miss the Starting Gun, I dwelt at some length on the importance of time and the need to save regularly over your entire working career. We can use return calculations to develop a simplified model, in this case based on the CRS, the Congressional Research Service report. And this will help show savings accumulation and the growth from investments over 40 years, which is your working life. And I've displayed it here in 10-year increments just so I could get it all on the screen kind of in one picture. Now, this is an example of how you can use some simple calculations to model your savings plan. And I'm, as I said, using the same assumptions used by the CRS reports. And that is an average investment return rate of 5.5%, a savings contribution rate that is 8% of your income, and income growth of 1.1% annually. That is, your salaries or income would go up 1.1% on the average every year. So I'm beginning here with current household income of $52,000. You can use your own value in your own calculations. I've done the calculations using an annual lump sum contribution, that is, assuming the contribution or your savings contribution comes at the beginning of each year, and this is just to simplify things. In reality, you would be making these contributions monthly or maybe even a couple of times a month. The other thing to keep in mind is I'm using average return rates. There is no way that your portfolio growth will be this consistent and this smooth. There will no doubt be potholes, dips and bumps, and maybe a crash or two on the road. So just remember the S&P chart from a few minutes ago. However, this example does allow you to better understand the potential of consistent savings. You can see that at the end of 30 years, you will have accumulated more retirement assets from your returns than you have contributed in savings. And by the 40 mark, your total investment returns are double your total contribution amount. And in the last 10 years, your total portfolio has doubled in value. In the end, you saved $207,000 out of your income, and your investment earnings added $450,000 to your retirement portfolio. The last 10 years are really important. And just remember, though, that you can't get to the last 10 years unless you save and invest for the first 30. Now, what I'm going to call a policy guide here for this episode is simply a recommendation that if you don't have Excel, that you get it, you learn how to use it. Get your own data and do your own calculations. And over time, you will build your own analytical capabilities. So let me close where I began. I believe very strongly that you need to be able to evaluate the performance data presented to you when you have to make your investment choices. You can't predict the future, but you do need to be prepared to do your own analysis and not just believe that everything that someone else tells you. This requires some simple numerical analysis and requires you to put things into a longer-term historical concept. context. So take advantage of the data that's available to you. And just to note, I used historical performance data in the examples in this episode, and I want to carry this further in the next one, which I've titled Charts and Graphs. And I want to take a look at some longer time periods as well as look at additional asset classes. In this one we looked at the S&P 500 and a little bit at the intermediate bond index. So probably I should, after this episode, I should call it More Charts and Graphs, and I'm going to talk about correlation too. And I will introduce the concept of correlation as we take a look at the data from the various asset classes. So I hope this experiment worked and that you will return for the next episode of Fund and Gains, the road to your financial future.